comes up, see mine says open in Safari, open in your browser. And if you just tap on that, and it looks like Google Docs, it's kind of green. Yep, and Credit 101. If you can't get it to work, just let me know, we'll help you. I also have it on my iPad. We have a way to get back in touch with you, and it takes all of that information, puts it in our database right away. So it saves a step.
Usually with these classes, you have to sign.
Auditing purposes, yes. Yes, and we'll pass that around the last 10 minutes or so of class.
Get started?
Yeah.
So what happens with everything? Jessica Garza, I'm here with the bank. As far as the building's been here almost a year?
Yes.
Coming up on a year? But we are not, so we are a community bank. We are a state savings bank. We do a lot of residential mortgage loans, as well as commercial real estate loans. I am one of our portfolio lenders, and I focus on mortgages that fall out. So unique borrowers and unique properties is what I focus on. We also do commercial and small business loans as well. This is Mick.
Hey guys.
He is our secondary market person, so he's going to do all of our traditional
Conventional,
loans,
FHA, VA, USDA, all the stuff that the bank sells off and does the service.
Susan?
Yeah, and we'll take it from here. Thank you
All
so
right.
much. Appreciate it.
Yeah.
I'm Susan Eisenhower, and this is Chris Bush. We're with Elevate My Scores, and we'll tell you a little bit about ourselves and the company. As found paperclip there, and as well as my business card, where you can contact a little bit more information about our company on that card, the longer card there. So that's all there for you to refer back to during the class. Here we are. Chris and Susan. Chris is the president of Elevate My Scores. He's been in credit repair over a decade. And I'll tell you that we are brother and sister. So Chris founded the company about doing what we do. And he's built a company that I was excited to get to step into him and help grow. So this is a part of that as kind of the chief educator and marketer too, to get to meet people and connect loan officers and real estate professionals. And
yeah, so like you said, I've been in credit repair for over a decade, and funny enough, I actually was talking with Mill. A lot of people around here have been working in the Austin area for a long time. So Susan and I were here to Georgetown, where she attended Southwestern. So she's been here for a long time. I think she did a small stint in school. And I know my mom lives in Sun City, right over here, and Susan lives right down the road over here. So we did this Credit 101 class about 3 years ago. We did this credit education to you guys. Now this class, even though I'm in class today, is to talk about credit, how it works in the mortgage industry. So you can understand better what your clients are having to go through from a credit standpoint. Please feel free to ask them at any time, raise your hand, just speak out, whatever. The only thing we ask is if you have specific questions about you or one of your clients, let's take those offline so we can kind of delve into those a little bit, more in depth. It's actually to the class and wanted me to look at it in the middle of the class and answer questions from one of his clients. I was like, well, let's talk about that later. So, but any other questions, feel free about the content, specifically about what we do, our prices, things like that. We'll kind of talk about that towards the end and take a little bit more offline about that. So, but I think that's about everything. We can go ahead and get started. So give us a like. You'll be entered in the likes raffle. The easiest thing to do, if you just open up your Facebook app on your phone, go to Elevate My Scores, give us a like, and then we'll actually put you in a raffle. It's got a little screw top. Pretty nice.
Yeah.
Holds
a little handle.
20 ounces of coffee. I'm excited about that.
So by liking our page too, anytime there's another class in the area, you'll see in your Facebook feed, we do post every refer to the class. You'll see updates about all of those company events that we have coming up. So
and as we grow this education, we are going to work on different classes too. We are actually our own provider, so I can come up with any class I want to and come and teach it. So I guess I could teach you about, taking care of your tree.
Talk a little bit about what's in a credit score. So why do you see three different?
And name those three companies.
What are they? TransUnion,
Experian.
they're encountering that are looking at buying a home, they think of their credit score as a number. That works, right? But why are the scores so different? Why aren't they the same?
Because not every.
All of the creditors report to all three bureaus. So you might have a medical collection that's only reporting on TransUnion, right? So your TransUnion score might be a little bit lower than the other. So if you layer all of those differences, that can
And one thing that can also report to the same bureaus on the same date. So you might have differing information. So when basically the data that's coming from the bureaus is the snap send the information to the bureaus. The bureaus are going to send to the credit reporting companies, which is when Mick pulls a credit report, that company that puts together that credit report, they're going to take the latest information that they have from those creditors. But those creditors can report a different team. We've seen that. So, and we'll get into more detail about how credit card balances and stuff like that can impact your credit scores. But in some cases, you may have different, and as we delve more into the model, that will make a little bit more sense.
Okay, we hear about algorithms like for Facebook has the number, how they're going to derive that number, and the factors that they use. There are over 100 different ways to compute. What did she just say? 100 different 650 or whatever. Isaac, that's where FICO comes from, the Fair Isaac Corporation, were two mathematicians, and in the late 50s and early 60s, they came up with, and they may not have even called it a credit score at that time, but it was a numerical value, up until, credit scores really became used. You just brought a shoebox with your bank statements and your tax returns and your pay home in the 70s, right? They didn't use credit scoring factor, at all. It becomes such a prominent, part of algorithms inside it. So we've just told you that a credit score is not necessarily a credit score, and a FICO score is not necessarily a FICO score. What's going on here, right? It's just that there are so many different factors that go into how credit scores are used in the industries that they provide scores to. Okay. Now, within those 49 different FICO scores, there are 9 FICO, and then 9 of those are mortgage algorithms, okay? Out of those 9, there are 3 that are the primary algorithms used today in mortgage lending, and they're called Classic 04, Beacon 5.0, and Fair Isaac version 2. Those are the names of the algorithms. So when you pull a mortgage credit report today, very likely it will even notate you that it was computed using those named algorithms, right? And those are the 3. So depending on where you go today, to Beacon 5.0 and Fair Isaac version 2. Yeah.
So you usually see it when Mick pulls a credit report, they actually have to state the names of the algorithms on their credit report, and they show them there. So if you look, go to and have different credit scores because different algorithms were being used. For it with a different algorithm and see if we can get a better result. But what happened was the investors, the ones that actually buy the loans, kind of got smart to that and be like, well, we don't want to buy a loan unless these algorithms are used. So then what did that do? Well, that drove the whole mortgage industry to go to something that's more standard out. We want these loans to be seen. And I actually had the president of the mortgage company call me up one time, and they said they got stuck with a loan on their warehouse. There's nothing in the actual mortgage guideline that wrong algorithm was used, and he wanted me to help. He was going to pay for the client's credit repair to get their credit score cleaned up so they can get their scores up using the right algorithm, which are the ones that we see today. And it was the culprit was really Classic 98. That was pretty liberal, and you saw some pretty skewed scores on TransUnion because of that. You would see like this really high score at TransUnion, the rest of them were down type thing, and they wanted to see that come down. So that some adjustments were made in the algorithm to do that.
I know we do leasing and property management, and when we go out, someone shows me, oh, here's my credit report thing, they'll show you on their phone, and they have like a 560. Well, we pull Experian at our office through our software. It's always like a lot lower. I've seen a 560 on someone's phone, like right here, because with Credit Karma or whatever.
Yeah.
And they have a 490 when we pull up.
Yeah, so I always ask people how many people use their phone to check their credit scores, and that's a good example right there. So what you're seeing is most of what you see on the internet and what you see on your phone and stuff like that is what's using what's called a Vantage credit score. So we talked about there's 49 different FICO algorithms, but you have all of those other algorithms that are out there as well. And Vantage is really more of a methodology and an algorithm kind of rolled into one. And what's the difference between a methodology and an algorithm? A methodology is FICO. FICO is a methodology, right? Vantage is also a methodology. But within FICO, you've got so many different algorithms. Vantage has 3 iterations to it. And right now we're on the 3rd iteration of Vantage. But where did Vantage come from? It was a project that was spearheaded by Experian. That they said, hey, we're going to change the way credit scoring is done. So they came up with the Vantage model. They kind of teamed up with the other 2 bureaus to put together this credit scoring model that was going to go from a 500 to a 990. And it was going to have these tiers like A, B, C, D. So you could come in and be like, people have been in the car business. Sometimes these terms are thrown around. This person's an A paper loan, so we know that we can get this A paper person, through. But it was going to be these tiers A, B, C, D. So you can just put them into tiers and make lending a lot easier, and that makes sense, right? But the problem was they left FICO out of the equation. The people that actually invented credit scoring. So what did FICO do? Well, they sued. They said, hey, if you do this, you will not just own all the information, but also all the way credit scoring is done to begin with. So they won that lawsuit, and so Vantage will really never see the light of day in most of the lending industry. And FICO, won that. So, and that's why FICO is in 90% of all lending decisions. Okay, so understanding that piece kind of gives an understanding. Well, why is Vantage still out there? And it's because it is pushed by the credit bureaus. Even though it's not a true lending credit score, it's some people use terms like fake or whatever, and it is fake, but it's still a way to gauge where you are as compared to other people. But it can be very misleading for people that don't understand that, and that's one of the reasons why I like teaching this class and why we start with this part of it, so you can really understand this. And I think if you understand this more than anything else, you can really pass a lot of good information to your clients, and that what you're seeing on your phone may not be the exact same score when you're pulling it, okay? So, but back to, why they're so different, and we see about a 30 to 40 point difference. And even though now the 3rd iteration of Vantage has the same range as a mortgage, the way it looks at scoring is so much. I think Vantage has like 7 or 9 different things that they look at. So there's a lot of different things that they look at that they factor in to come up with the credit score. But about 80% of the time, we're going to see that across all the different industries, the mortgage scoring is going to be the lower of all of them. Okay, for a lot of different reasons, but then also because of the scrutiny that the algorithms that have been put on there keep those scores really low. So they put a lot of pay back this loan, and that's the whole point of a credit score, right? It's to tell a bank. What's interesting, one of the classes we did in Houston actually had a guy that used to work for FICO that was sitting in the class in FICO UK. But now he's a realtor in Houston. But it was interesting hearing that, and he used to work with Barclays, and the algorithms they look at based on credit scoring. What's the likelihood if we do this and we do that, go into it to determine this, and that's what a credit score is. And some people think it's unfair. I'm like, well, but it is your standardization of how likely you are.
On your bank website, is that going to be more accurate than?
Probably not. So a lot of times what you see when you go to your bank, like Discover, Capital One, Chase, and they're like, show me my FICO credit score. And you're like, this is FICO. Come on, it's got to be the same. No, still not the same. Yeah. So FICO has a couple different algorithms that they use out there, FICO 8 and FICO 9. FICO 9 is the most recent iteration of this. It's still used for to kind of be more public facing, but it's still not a mortgage credit score, and it can sometimes be 20 points higher than a mortgage credit score. We see, so it's a FICO, but it's still going to be higher than a mortgage score. And I'm sure you will say like, oh, well, I'm pulling FICO score. Click here to see your FICO score. It's on there, you would eventually end up applying for a Capital One
like
credit card.
My credit journey, you go look at your mortgage, how much you owe on your mortgage, and you can click on the thing.
Yeah, and it's still not a mortgage score. Because the thing
That's
is,
wild.
because if you can continually, if you have a bot that can pull that 1,000,000 times,
Yeah.
then it can easily be manipulated. So that's why there's actually a cost to pulling it,
Yeah.
and that's why banks pay pretty good money to closing that they pay, and it's to cover the cost of not just that pull, but all the other pulls that don't go through to kind of recoup some of those costs. But it can be like $20 to $30.
Explain it to my clients is that what they're getting is a consumer version.
That's another term that's used. That's a good analogy.
You're getting really crazy stats from Zillow's estimates, where you have a professional like us pull comps for you, and that's you're getting the real true number.
Yeah.
So that's just
It's a kind of a good analogy, I think, to get people to understand. A techie person like me, I'm thinking like, well, it's not totally, but it is. That's a great analogy. I like that to kind of get consumers to understand that why it is different.
It's also calculating the risk of borrowing that large amount of money, right? Whereas the other scores are about, getting approved for $1,000 credit card or $20,000 car loan, right? So it's just different end result that's expected there.
But going into that depth with somebody who just gets into the weeds and confuses them more than just here's a simple analogy.
I like it.
You should be able to understand it.
I like the simple, and that's the thing. That the point is, so you can understand the more technical stuff of it. But if you can really, help your clients understand, like, look, it's not going to be the same score. I remember I had a client that actually yelled at me one time because her scores were different than, her Credit Karma scores were different than her mortgage scores, and she's like, "Oh, you." Okay, that's not what I'm trying to do, and I'm actually trying to help you.
You won't have to worry about it.
The range of an auto loan actually goes up to a 900. So you're typically going to see score sometimes throws people off too. Like, well, I just bought a car and it said I was a 680, and now you're telling me I'm a 630. That was your car algorithm. They use something completely different than mortgage. So,
we're not saying that Credit Karma is bad. Is to really understand what it means and what it's going to do for you. And if you don't, is there something new that I need to, address, right? A new collection or a new late payment I didn't need,
Yeah, I just feel so bad for them when they pull Credit Karma, because I always ask them, do you know your credit score? You're going to be qualifying for this. And,
question.
Not to veer us off, how does that fit in right now with either FICO or mortgage loan?
But one other thing I wanted to add about, so Credit Karma and these other apps might not be, they're not horrible, okay? No. What a credit score tells you is like, well, something's bad, right? Well, what is bad? How can that be solved? I've got a medical. It still will tell you those things on there so you can see that there's a problem that needs to be addressed, for credit monitoring when they go through our program. And it's not a mortgage FICO score that we're looking at. But we know that if things are trending in the right direction and we see things that are happening that were, on their credit report, then we know that things are going in the right direction to help them get qualified for that home loan. So using it to track is still not a bad thing, but just understanding that there is a difference in the credit scoring, I think, is the biggest.
Why does it seem like what he was just talking about, like medical payments and student loans, hit harder on a credit report than, let's say, a credit card?
So you're talking about like a medical payment or a medical collection?
Medical collections and student loans.
Because a medical collection is going to be a negative.
So student loan.
Yeah, and I've actually seen, student loan isn't a negative unless it goes into collections or is late.
Right, well, the same thing.
And we're at A&M and had great credit scores in the 800s. And he had one medical collection that was a paid medical collection, so it was actually $0. And it brought his score down 130 points.
Because it was on the report, is that why?
Yeah, because it hit. Because what happened was it was a mistake with the billing, with the insurance company. It wasn't something that he was even supposed to pay. So it got billed, sent to collections, but before it actually hit his credit report, see, as a paid collection. So it was a $0 collection, and it brought his score down to 130 points. And how I knew that was because we had a snapshot of 2 different credit reports, but it only went on 2 of the 3 credit bureaus. So one of the scores was really high. It was like an 830 something. And that was the actual mortgage score, which they can tell you that's a high score, right? If you see somebody with an 830, you're probably doing backflips, right? So, but his other 2 scores were like a 690 something. Now that could still get qualified, but you're going to get hit on the rate.
Isn't it something over 750's bragging rights or something that doesn't really matter?
Yeah. And we're going to talk about that here.
That's another question I got. Who developed the number system? Because I mean, like, back when I went to school in the 60s, from 0 to 100, 100 was good. And now you're talking about, okay, well, 550 is bad, but then you send 840 or 850.
Wasn't we talking about FICO? FICO did.
But why don't they go all the way to 1,000 instead of 850?
Well, they tried that. They went to a 990 almost, and well, that didn't really get adopted. And then there was a lawsuit.
But 850 is the greatest score you can get. But it's like, why does it stop at 850? Why doesn't it go to 1,000?
I don't know the history behind that. Mr. Fair and Mr. Isaac are no longer on this planet, so I can't really ask them. But I'm sure there might be some, good history book or something. I could probably go check out from the library and find. I don't know why 850 was the magic number.
Because I remember I bought my first house back in the 70s, and they didn't have the FICO scores. But then again, I worked at a bank at the time, and I got the loan real quick, But it was just basically how much you made and basically how much debt you had. It didn't have anything to do with the score.
Yeah. So one thing, you're not going to be over the second half. Credit scores you need for different loan amounts. Do you mind talking about that real quick? We'll put up the slide. You want to go to that slide towards the end? Do you mind talking about that real quick? Just as far as like FHA, conventional VA, what credit scores the client typically needs?
Like on an FHA loan, typically if you want to see a 640 or above, we can go below those credit scores, but from 600 to 620, there's a level of difficulty getting that loan done. There's certain additional requirements needed where we might have to verify their rental history or document something more in detail if there's an issue with the credit. So when you go down lower in the credit scores, the loan becomes more difficult to do. And then plus, when you come down in credit scores, you're also looking at a level to the interest rate pricing. So typically on a lower credit score, the interest rate is going to be higher than what market is. So obviously, the better the credit score, the lower the interest rate for the client. And then when we talk about conventional loans, if they're not putting 20% down, the mortgage is going to carry mortgage insurance. And mortgage insurance can be pretty expensive when the scores are low. But when the scores are extremely high, it can get really cheap. So there's lots of variables there, and the end result, meaning the payment of the mortgage, is going to be adjusted, and that's going to determine how much of a home that the clients qualify for. Obviously, the higher credit score, the lower the MI, the more mortgage they can afford, so the more expensive a home that you can go out and show them. So.
Yeah. No, that's good. And that's kind of and that leads into what you were asking about, you were talking about those things mattering as far as, or you were asking about, well, when does a credit score not matter? So what's the highest credit score that you can have on a conventional where you don't get a hit?
740. You go below 740. There's no real more adjustments to pricing. So if you're a 740 or above, you're as good as you're going to get.
Yeah.
There's the bragging right thing.
Yeah.
Any higher than 740.
Yeah.
Yeah, it doesn't matter. I remember I had a conversation with a client who actually wanted to sue one of my loan officers because when he did a refi, his score dropped from an 810 to a 790. And he wanted to file a lawsuit against the loan officer. And I spent an hour on the phone. I remember I was walking around Home Depot on a Saturday, and my loan officer was like, "Can you just call this guy?" Because he has his lawyer calling me. And I spent an hour on the phone with him, basically giving him this class, explaining him credit scoring, so he wouldn't sue my loan officer because his score dropped, 20 points. Which it's actually, and we'll talk about some of the things that causes credit scores to drop when you do new loans and stuff like that. But it's like, come on. As I told him like multiple times, like a 790, you can get whatever credit you want in any industry, it's not going to matter. And if you walk into a car dealership today, you'll probably be an 840 and those guys will be doing backflips to sell you a $100,000 Tesla. I'm like, come on, dude. What is your problem? So it's like, it's over a 740, it doesn't really matter at that point. And it's 20, it's just like 20-point increments on conventionals, right? Where each 20 points, there's a rate adjustment.
Yeah. So 680 to 700, and then there'll be an adjustment on that. Mortgage insurance will be a little bit cheaper if you're above the 700, and then you go above the 720, and then above that magic 740 number, and that's where you're going to see the best pricing discounts.
And then what about for like USDA and VA? What kind of credit scores?
So USDA, we're going to need a 640 credit score, or else we're not going to get that GUS approval through the system. And again, on the USDA, they're pretty stringent too on the DTI, debt to income ratios.
Yeah.
Within the guidelines, 29-35.
Wow. Okay. Well, great. Thanks. I wanted to get that in because I know he has another engagement. But something we always like to do is bring in a mortgage loan officer to kind of talk about those different rates and things change. So if I start talking about it, I'd be like, no, Chris, actually that's different. I'm like, oh, sorry. So I don't want to say anything that's not current as of today.
Did you say what the VA one was? I'm sorry. Did you say what the VA?
At VA, we can do down to 582, but once you go below the 620, the loan becomes difficult to do. A lot of the times when I see scores below, especially below 600, I'll almost advise the client to do some credit repair to get their credit scores up, rather than going through the stressful process of trying to buy a home with the lower 600 credit score.
Okay.
And also in a competitive real estate market, the higher your credit score is when you go in to put an offer down on a house, especially in a place where there's multiple offers going in, that can make an impact. Something I didn't even think about, in one of my realtors in a class that I did brought that up in a home buyer class when he was saying, like, somebody has two offers on the table, one's an FHA and they may or may not qualify, versus somebody who's a conventional loan. They're probably going to give the offer to the conventional buyer, because they know that, hey, we're going to accept this offer and we know it's going to go through and not back out because of credit score purposes. So whatever a client can do to help get their scores up and be in a strong position is going to be the best thing to do to be able to buy a home. So thanks, Mix. I appreciate that.
Okay, so we're going to kind of press forward because, this class always brings up so many good conversation topics. So thanks for sharing and adding to, the richness of what we're learning today. So there are 5 sections in the mortgage FICO scoring model, different percentages kind of mapped out there for you. You have that in your packet too. So we're going to break down each section and talk about the impact to your score based on that. So the largest section of the credit score is payment history. 35% of your credit score is based on the payment history of all of your open and active accounts. Okay, everything that's installment and revolving is all calculated in this section. Okay, really important factor here to consider is also months of review. So every time you have activity, making a payment on an account, you're ticking up that number months of review. And the greater that number, the greater impact that account has on your credit score. So an installment loan that you have to make a payment on every month can really have a large impact in this section, right? A revolving account that you may or may not have activity on, it kind of varies in how that one impacts you here, because you might have a card that you aren't using, and it kind of sits in the back of your wallet just for a rainy day, right? So that one may not be impacting you as much as something like an installment account will in this section. This is also where all of your negative information is calculated. All of the late payments, collections, bankruptcies, charge-offs, anything that is negative is calculated in this section, which explains why, too, if you have a recent late payment on something, why your score can really be so negatively impacted, up to, 80, 90 points sometimes with that late payment that would hit, and because it calculates here, okay? Now, notice we said that this is for all of your open and active accounts. So when you have something like an auto loan and you're so excited you get to pay it off, right? Woohoo! You made that great financial, accomplishment of paying off that car loan. Has anyone experienced where you've paid off something like that and your credit score actually drops?
Mhm.
Yes. Okay.
It did.
Yes. And so that's why. So that account is no longer open and active. And you had really been working on increasing that months of review so that account was growing and really benefiting your credit score. When it was closed, it's still listed on your credit report. It's just no longer calculating in this section. And that's why a loan officer, after you get that, that initial approval, right, is going to say, don't pay off anything, right? Even if you want to, because that feels like a really good financial decision, which it is. But in terms of the credit score and your closing and the timing, right, that you need to really be careful of that.
Yeah, that happened to me. I have 5 home installment loans. I own lots of property. And I paid one off, then my credit dropped. So I paid it off.
That explains it. Yeah, that's what
And
happened.
it dropped like 15, 17 points. I'm
Yep.
I paid off the loan.
I know, right? You completed your obligation. You were a responsible borrower. Yeah, all of that, but it negatively impacts
Because
you
you're
here.
not
So,
playing in the game.
right,
Basically.
Yeah.
It's a game, basically.
right. So, anything to add?
No, I think that's.
Okay.
That's cool.
All right, so the next section is amounts owed. 30% of your score deals with credit card utilization, okay? Now notice I said credit card and not installment account. So in this 30% section, the only thing that you'll gain points for here is revolving accounts like credit cards, okay? There's nothing about this section that it deals with installment loans at all, okay? So now if you take away this section from your credit score, you'll see we've got about, 2/3 left there. That's what your credit score potential is if you don't have an open active credit card. Okay? Right? So it's like getting a piece of pizza with 2 slices missing, right? So if you have no open active credit card, you get no points for 30% of your credit score.
Wow.
Okay? So some of those folks that are coming to you with that super low credit score may be because they don't have an open active credit card, right?
Yeah.
You see a lot of cases like that. How many people that you know that say, I don't believe in credit cards, and I'm too scared to have a credit card, or, I saw my family members, not do very well with them, and I just vowed I'm never going to do that. So, right? But
Yeah,
what they
and
don't know
millennials
is that,
too.
yeah.
I mean, it's like some young people in the younger generation don't want to get credit cards. They saw
Or
their
pay
parents.
cash for
Yeah.
everything.
They pay
Yeah.
cash.
Yeah.
And nowadays, with having, your debit card, your Visa, what are like prepaid cards at Walmart, put money on there, and they use that, all the time, and they think that's like a credit card, and they think that that's smart, and it might be financially, but it does not help your credit score, and it's really that.
Yeah.
And one thing to understand is like anytime
Use it,
you,
pay it, use it.
anytime you go and get a tank of gas and you put it on your Capital One Visa card, you're borrowing money for that $50 or whatever to put gas in your vehicle.
So that doesn't include your bank debit cards then? Like
Oh, no.
Correct.
No.
Correct. It does not include a bank debit card. That does not.
Forth based on the balances of your credit cards, okay? That you have on your credit card balances, the less points you're going to get, okay? The lower utilization, the more points you're going to get, okay?
So in other words, if you put things on your credit card and pay it off every month, that's your best bet.
No, don't pay it off.
No, that's
Well, so basically the utilization works like this. Let me kind of give you an analogy. So let's say you open up a Capital One credit card for $1,000, okay? And you go buy a set of tires for $900.
you've used
What
almost all
you're
the
using? What percentage?
90.
90%.
90%.
Yeah. Okay. So at 90% utilization, you're actually losing 10% of the points you could potentially be earning towards your credit score.
'Cause
Or you're
you're
earning
losing
10% of the points you could potentially earn. You're losing 90%, but you're gaining 10% of the points you could be potentially earning towards your credit score. Okay? So that means you're almost maxed out on that card. But if you take that card and pay it down to $300, what are you utilizing? What percentage? 30%, right? So now you're down to 30%. What 30% you're only losing 10% of the points you could potentially be earning towards your credit score, and you're getting 90%. So it's this kind of this curve that goes up and down. So the lower that percentage is, the more and more points you're going to get back towards your credit score. And so that's why keeping it at that lower percentage is what we recommend. Now, a lot of people will say 30%, but sometimes we even try to get people to pay down to 20% if they can, because that's going to help really maximize the points that you're earning on that credit card. Now, there are a lot of different factors that play into that, and we'll talk about that more as we go along in the model.
So in other words, a platinum card where you can have $50,000 or $100,000 limit, and if you only use 500 of it every month, you're not really taking full effect of that section.
No, that's not it at all.
No,
in fact, your utilization is really low, so that's a good thing.
Right.
So anytime your credit limit gets increased, that's good. It has nothing to do with how much are you using. It has nothing to do with that. It has everything to do with the percentage of utilization the higher that is, the less points you earn towards your credit score. Now, it's not technically a negative, and that's the point here, is that some people think like, well, I'm negatively impacting my credit score by having it maxed out. Not really. It's just you're not earning as many points as you could, okay? So let's just say theoretically that $1,000 credit card we just talked about earns you 100 points. No, it doesn't, but let's just say theoretically it does. So at 100 points being earned at a theoretical 0, if you have 90% on it, how many points are you earning towards your credit score? 10 points, right? So that, and then if you pay down to 30%, well, now you got 90 points that it's earning on towards your credit score. So that kind of gives you an idea of what type of swing by just paying it down. So if you have a client, I'm sure Mick's done this 150 times just in the past couple months, where he's told the client like, oh, go pay down your credit card, and we'll pull this thing again and we'll see what it looks like. So a client goes and pays off that credit card that's $1,000, like, oh yeah, I've got the money to pay down because I'm putting 20% down. I can take some of my money and put it towards my credit cards and get those balances down, and then boom, their credit scores go back up. So it's an ebb and flow. And remember, and I'll get to your question in a second, but remember we talked about before about how the different dates can impact you. This is exactly what we're talking about. So if you take that credit card and you paid it down to $300, but you have 2 of them that report at a certain date, and maybe those dates are reporting on the 15th, the other one's on the 1st, and one reports 900 and the other one, 2 of them report 900 balance and the other one reports a $300 balance. That means the one with the $300 balance is going to have a higher credit score than the other 2, because those kind of things can matter. And these are just simple things that we can look at with a client. What we do is credit coaching with all of our clients to help coach them to help raise their credit score. Like, apply this money to this card and do it in this fashion, and we'll see those scores come up. Okay.
And this is one.
I'm sorry.
No, I was going to say real quick. This is one part of improving credit scores that can be a quick fix. There, in terms of getting negative items and addressing some of those like late payments and those other things, those aren't always quick fixes, but this can be done really quickly, which is why a loan officer is going to, when they have a credit report that comes in, very often they can forecast what the new credit score would be if they paid it down to $17 or something like that, right? And then they're going to use that.
What was your question?
And how soon after, let's say that they paid down their balance?
It's a great question.
How soon does it show?
2 to 4 days, we can get it done.
Yep.
That's when you do the credit score.
So we basically ask them, give me an updated statement that matches the credit card number that shows what the new balance is, and then we take that to our credit reporting agency, and they update the bureaus. There's a fee for involved with doing the score like that, but the end result, the credit score goes up, but the interest rate goes down, and the mortgage insurance goes down, and so it's worth it.
And let's say they don't do a credit rescore, how soon does it show? Let's just say.
Yeah, so that can take anywhere between 2 to 5 weeks. If you,
maybe the next month.
Hey, come on.
yeah, we are. We're going to take a break right after this section, so we'll go ahead and. Hi, how are you? So about 2 to 5 weeks typically is what it takes if you let it just kind of organically update. But like what Mick was saying, he can do a rescore on it and get it done a lot faster. And 2 to 4 days is pretty quick, so that's good. Especially when you're people are freaking out and they're trying to, get a loan closed. And having the ability to do that is great. So we're going to talk a little bit more on this section here, and then we're going to take a break here.
So real quick, let's talk about the next section here. 15% of your credit
I was going
score.
to. I wanted to.
You want to say one more thing?
Yeah, I wanted to stop after this section.
Oh, you wanted to stop here? Okay.
Yeah. I know it's a different break point, but we kind of just changed things up
All
a little
right,
bit.
we can do it.
But I just wanted to make sure that everyone understands about credit cards, credit utilization, and just how important, and that really when you're talking with your clients that have lower credit scores, especially if you have somebody that's in the high 400s or low 500s, it's typically because of this. Okay, that means they don't have a credit card, and sometimes just adding a secured credit card, and we'll talk about building credit in the second half of the class, can sometimes add 30 to 40 points right away just by getting the secured credit card. Why? Because they're all of a sudden scoring in this section here. But for those clients that do have credit cards, just understanding that, this part right here, lower utilization equals more points. That means the lower that percentage of utilization is, means more points are going to be going back in their credit score. And it's an ebb and flow. So your credit scores may, it may go down, but they can come right back up by paying them down. I think one of the things that was brought up about, so I need to use it and don't pay it off, or use it and keep money on there. And that's not necessarily true either, in that, because depending on when you actually make that payment each month can kind of depend on how, what gets reported and how that score is. So a good example I like to use is like realtors. Sometimes you get paid once a month. You use a specific credit card. You want to get those points, those airline miles, whatever. You charge it up, and then when you get your big commission check at the end of the month, you pay it off. Well, that can be fine, but if you're looking at your credit score, depending on when you pay it off, can have a detriment, because if you're always running up to 90% and that's what gets reported, so even if you have it at 90%, that gets reported to the bureaus, and then you go and pay it off down to $10 or $0 or whatever, what's reported is what's going to actually be in the credit score. Okay, new balances. You can call it the credit card company and easily get a letter and a new statement basically showing the new balance. So, well, we've got Elaine here. She's with OneGuard. And my mom uses OneGuard home warranty for her house, so that's kind of how we know Elaine. And she brought some amazing Olive Garden here. We're gonna take a quick break. Let you guys dig in, and then we're gonna have Elaine say a few things about OneGuard before we dig in.
Okay.
I'll go ahead and I'll do this if you want to go ahead and speak. I'll get this stuff.
Well, I have to go get my brochures. Yeah.
Okay. If you want to do that,
They're driving fast. They must be no traffic. There's where you are.
333 miles.
To Indy. So they should be there in like 5 5 or 6 hours. It's like driving from San Francisco Bay Area down to Disneyland.
That's great. Thank you.
Thank you for giving the information.
Yeah, it's probably 6-7 hours.
Because it was like 350 miles, I think, to drive down to LA, and it would take us like 6 hours.
I've done that. So we're gonna get there. We're gonna be there before the kids get there.
They are. So what do the kids do when they get there tomorrow?
They eat. Really, they're getting so late.
There's pasta and
Lights out.
salad and breadsticks, so everybody can help yourself.
All right.
Raise it up.
I'm not proud. Come on, guys.
There's plenty of food.
Ladies first. No. Ladies first. Ladies first.
Go for it.
Are you sure?
You guys can eat further than it didn't show up. There's plenty of food.
This is one of my favorite parts about Oliver.
Oh, yeah.
The candy mints.
Oh, I know.
Nope, because the new one's not open yet, right? So we're.
They're hiring for it, should be pretty soon. She must have had grabbed this from.
A little bit of a trek.
A little bit of a track, yeah. And then it wasn't quite ready on time.
Of course.
Do you want my keys to go out
Yeah.
in the car?
I always feel like I make a huge mess when I eat with these things. Don't you?
How is it?
Good.
Is it good?
Olive Garden yummy.
Yeah. It was amazing. I went to Italy. I don't think I found food as good as the Oliver when I was there. Get like really good food.
Our broker went to Italy and he was upset because they would serve cold cuts a lot. Like,
Oh, yeah.
because he went on a tour and everywhere would be like cold cuts and bread, like sandwiches,
Yeah.
basically. And he was so upset because he thought it was going to be more.
Horrible. But I don't think I went to the right places. You know, I've had friends that have spent a lot of time there. They're like, oh, you need to go here, you go there. I'm like, oh. I didn't see a good food.
Yeah, I definitely think you have to. And I went to Italy and I used the Rick Steves book.
Oh, yeah.
That was so helpful. I found places to stay that were,
Yeah.
and it was on in
I
that
don't
book.
know. Maybe we had Odors. I think there were photos book that we had. I don't know if we places in Florence, but we couldn't find anything in Rome. But yeah, we did. I know if we eat it. Like for that.
Yeah. I really was very.
Oh.
She didn't live in Rome though. She lived in outside of Naples.
Between Italy and the U.S. and there was one point where we're booking a room. We were talking like we booked it and they're like, okay, good. I'm like, but don't you need my credit card? You know, whatever. Them to like or anything, just your word. Not booking a while.
Oh, that's great.
Talk while you guys are eating, and then
Nice to see everyone. Did everyone get a brochure? Mm-hmm. Yeah. Have some of you heard of One Guard before? Mm-hmm. Yes? Oh, good. So OneGuard has been in business actually for 29 years. We've been in the Austin area for about 6 years now. And I've been with OneGuard for 5. And some things that we're kind of known about, some things that kind of stand out about OneGuard in the home warranty industry. Definitely I want to start off first in sharing with you some of our customer satisfaction ratings. Satisfaction ratings can be and not always be so high with the home warranty industry. So OneGuard has, and companies don't even cover an A rating with consumer reviews. And I think this one will resonate on Google reviews. That's really, really strong for a home warranty company. And a OneGuard renewal rate is around 70%. The national average is around 35%. So I think that really speaks volumes. This, when you look through the plans, in the middle of the brochure are all the plans listed out. There's like a table. And homeowners will say, what are those items at the bottom? So at the top of the table, you'll see the warranted items. And it checks off the items that are covered under each of the plans. And then at the bottom there, you see services. And that's usually the question I get from homeowners. They're like, what are these? I've never seen these in a warranty. These is something that we do a little differently, is we bundle in fee, and our service fee is $69 for claims and for all those services. So definitely our most popular one is the rekey service. Also you have ceiling fan installation, carpet cleaning, window cleaning in the brochure, because we just rolled them out a couple months ago, and that's power washing, gutter cleaning, and the power washing are $75. And there are, of course, some limitations there. And then mounted professionally. We've always just done it ourselves, but after we started, that is very low. Yeah, professional TV wall mounting is like $200 and up. I mean, it's pretty expensive. Highlight is our HVAC coverage. As you guys know, HVAC's the most expensive system to cover. Even those old systems that use the R22, the Freon refrigerant that's being phased out. And we will, so all forms of AC refrigerant will be covered at 100%. You're probably sick of hearing about the phase out, but I think people are still a little bit confused on what's going on. Phased out by the Environmental Protection Agency. This has been going on for a while now. As of all these R22 systems, I tell that was built 2010 or later, or they had an AC system installed 2010 or later. There were some 2007 that convert. We will no longer manufacture as a homeowner. Okay, so I think some contractors are scaring some of our homeowners, and so that's not true. Okay, it just won't be manufactured. We actually have more purified and reclaimed arc one continue to cover it next year. Now the pricing will continue to go up, of course, and people are going to choose the system. Just know that doesn't mean necessarily that they've got to switch it out right away. Because I have worked with some realtors where, just that my AC system is still working, I'm not going to replace it, and the buyer is saying, no, I want it replaced. So just know that you've got some options there. 22 at all. It won't be able to be used at all.
Is it 2029?
29.
Wow, so 10 years.
Yeah, so we've still got some time. But if your buyers or sellers or yourself have a newer system that's the R410A, that refrigerant has really gone up in price. So right now you're looking at $65 to $75 a pound. And you say, well, why? Because they can do it. And unfortunately. So I bring this to your attention, and that can get very expensive, especially if you've got to change something out and evacuate the system and recharge it. That can get pretty expensive. A typical system holds around 10 pounds, just to give you an idea. So if they're paying, if they're charging $65, so those are the main things. We also have seller's coverage that has become much more popular in the last, I'd say, year, at least with me. And I think it's one reason is because our seller's coverage is one of the most complicated in the market. What I'm seeing a lot of is some of the new contracts that are coming out, new home warranty contracts. they're starting to put aggregate limits on things, like an aggregate limit that they'll pay out on seller's coverage. For instance, they'll pay out the question. Even on the buyer's plans, I'm seeing aggregate. Well, if you've got 2 systems and 2 of them go out, you could hit that pretty easily. And then after that, buyers and sellers know that to ask that question. Are there any aggregates? Our plans, I just found out we're going to be getting new brochures. So that's wonderful news because they talked about some increases. So those are kind of some highlights. Oh, on our seller's coverage, I'll go back to that, sorry. Seller's coverage is identical to that basic plan. So if you set up listing coverage and then use those services during the listing period, so the carpet cleaning, the window cleaning, those things can be used. Only the $69 coverage. There's a one-time $200 charge to initiate the claims process. Then, let's say, I'll give you an example. Let's say the HVAC goes out. And now let's say the water heater goes out. They would only pay the $69 service fee. Now, so let's say you had $500 in the contract for the buyer, and you choose that $499 plan, which is our Sentinel Plus Preferred. Buyer's not going to even be aware because they're going to pick the plan. They pick the $499. The seller would only be paying $299 instead of the $499. Also, I have some agents $200. I had one that just did this. The buyer selected one guard, then the listing agent, she got, the buyer goes with one guard and there's a claim, you're going to get that $200 back. For it, so we lose money on it. And the way one guard policy in place, and if you've had a claim, it really is in the best interest for the buyer to go with the company that did the work going to stand behind it. Cool. Does that make sense? Mm-hmm. Yeah. Okay. You guys have any questions? Or my email address. And I will say another thing that's positive with warranty companies is your rep. Do they have a local rep? 1, and 2, does your rep get involved? Does the company empower them to get involved and help out if there's an issue with expediting a claim, a denial, so you can call me if there are any questions or you need help with anything. Okay? Thank you.
Okay. You might find us talking.
We'll probably go to 10 after 1. But we'll probably pass the sign-out sheet right around that time. Yeah. So,
as you need to take care of your trash, there's a trash can back there, and feel free to help yourself to extras.
Seconds, thirds, whatever.
Yeah, extra breadsticks.
Take a plate home. Whatever.
Yeah. Get a minute. Okay.
Definitely get a minute.
So continuing on in talking about the mortgage FICO scoring model, we talked about the 2 biggest sections, and we're going to pick.
Yeah, so length of history is basically an average of your open and active accounts, both your installment and revolving. In order to maximize this section, you need to have 25 years of average, contributing. So really, the reason why we point this out and why this section is so much is a credit card score on your credit report. Well, this is a big one. So length of ago, or was it open 6 years ago? And it helps you make a lot of good decisions when we're credit coaching and talking with clients about their credit history average, or add depth to it. And there are things, and we'll talk about that here soon, about sometimes when people want to go like, well, I want to go and open up some new credit or whatever, well, that can hurt your credit history average. This credit history average by technically manipulating the section. And the biggest one is authorized users. Because they have a credit card, all of a sudden, boom, they have this huge instant credit score, and where they didn't have one before. But where we really use it when we're credit coaching is that when you have a client that's got kind of a thin credit file or lower credit history average, if they have somebody that they can get added onto there, it can help lengthen this credit history. The good question?
Yeah, on the authorized user, I have a question on. So if we recommend them to add to mom, dad, blah, 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 but mom and dad don't use that card that often, does that hurt? Or
It could. It's funny because I actually had a client in Waco, and I remember he was an authorized user on his parents' BP gas card, and they didn't close it down even though it hadn't been used in like 9 years. So, but it was still open, but it was essentially not really contributing. They did, and his scores went way up because it started contributing back into it. So that can be a factor, and yes, it does help if it's going to be put on an older card is one that gets used, and it could be just as simple as, hey.
Question, I'm sorry.
Yeah, go ahead.
The authorized user, so is that okay, so if it's his credit, I'm an authorized user, that makes my score go up or makes his score go up?
So whoever, if you have somebody that, let's say, has 2 years of credit history and gets added to person B, let's say it's the husband that has 2 years of credit history or has no credit history.
Okay.
And then gets added to the wife's card, a couple cards, and they were opened up in, say, the 70s, and they're really old, and boom, all of a sudden now that credit history goes from like 0 to 25 or whatever, right? And the scores go way, way up.
Okay. But
So, and that's a real life story, actually, is I had a client, no credit whatsoever, no installments, no credit cards, anything, and she had great credit, scores in the 800s, and a bunch of credit cards that have been opened up since the 70s. Well, she added him onto 2 of her cards, and boom, he got 90 points within like 3 weeks.
awesome.
And they qualified for the home loan just off of that alone.
So when your child turns 18, Adam is authorized user.
Adam is an
Yeah,
authorized
before
user.
that.
You can do that.
Before that?
Yeah, and they don't have to have a copy of the card.
Yeah.
That's the thing, right? Right?
Yeah.
You're not a joint user, so it's not.
But you're supplying their social security number though to the credit card.
User, it's kind of crazy how it can work in that it's just name and address, and then they can find you because and it's not based off your social security number.
Apps, you don't put your
Yeah.
social on there.
Yeah.
Yeah,
And is it true that not all companies allow you to do that?
that is true. Authorized users, and now they do.
No, they don't.
And then for a while, then they allow. We'll talk about building credit here in a second, but one of the companies that we recommend for a secured credit card does not allow authorized users, and most secured credit cards do not allow authorized users.
I'm sorry, what is that company that you recommend?
It's Open Sky Visa. We'll talk about it again here.
It's actually in your packet too, under the number 3 there, the website for them.
Oh, okay.
Yeah. One thing to add to this section too, a lot of times when it comes to credit cards especially, we make emotional decisions like Chase really, blah, 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 credit card company really, chaps my hide. I'm tired of them. I've got this new shiny card. I'm going to use this one instead because I like it, and then by years, you're erasing all of that history and lowering your average, right? So that's one of the things that we get asked about. Well, I thought it depends. So if you have a really low average because you've opened up a lot of new credit, maybe you were remodeling your house and you opened up, but your average is kind of low, but actually closing some of those accounts carefully might help improve your average. Emotional decision and close down that oldest trade line that you have. Then opening new credit, like maybe you have kind of a thin credit file. Chris has talked about thin versus thick credit profiles. Let's say maybe you've only got one credit card and you're down to buy, Instacart or whatever shoes, right? But then when you only have one credit card and then you open up something new, now you have 2 cards and you have the same length of history total, your average is cut in half. So that's why having a thicker credit profile can benefit you here, having depth of credit. So that if you have it's not going to really adversely affect your average as much as if you just had one open active trade line. Cool. Does that make sense? Okay. So let's talk about new credit. That's the next section here. And I must be standing too far away from the thing. There it goes. New credit. So I'm sorry, no, actually types of credit. New credit is last.
Yeah.
So types of credit is next. So it's best to have a good mix of different types of credit card and installments accounts. You can't have too much of a good thing, like a perfect picture, and how to get the most max out of this section. Your score can be negatively impacted by having too much of a certain types of accounts. You can have too many store card accounts. We've actually seen a credit report that had that notation at the top, too many open store accounts. And when we learned, she was a shopper, right? And they were all in good standing. She was using them, and so you think that it would be benefiting her score that those were all, with that client to help close some of those accounts to get that reason code to fall back off. But then we were really careful about the length of history, that section we just talked about, right? Because we wouldn't want to close down the oldest ones, right. So definitely. You can also have too many financial accounts. So a financial account would be like a personal loan. Very often those are short-term, small balance type personal loans like payday loans. And very often they're done cyclically, right? You get one, pay it off, go get another one, pay it off, get another one. So if you're the type of person that does that habitually, in a cycle, right? One after the other, from an underwriter, what does that look like?
You're broke.
You have a hard time managing your money. Yeah, right. You can't.
You're broke.
You're not getting the budget, right? You're broke, right? You get to the end of the month and there's not enough paycheck left, right? So that's kind of what happens there. And I think they're very often marketed as something that helps you, right? Well, maybe one wouldn't be too bad, right? As far as having an installment loan and paying it off. But having a series of them is where we get into the issue, right? And then the last section is new credit.
Yeah, I'll take that. So new credit is, anytime you open up a new account, this is what's going to get it. The first one is anyone on the phone with DD. You apply for a loan, you have an inquiry. It doesn't exist, right? Inquiry, okay? That credit score. We can get back to inquiries in a second, but let's actually go down. Okay. That HUD actually, how many defaults that got? Yeah, so it means that people make
60 days to make their first
make a payment.
I'm not gonna.
It happens, but it's opened up a new credit card. One of the big all the time, they're getting really. It's like, well, I got into an accident, I can't. Okay, something because you're tired, your car. That's different, or if you have a lease trade-in or something like that, before you buy a home, you might as well try to live in the car because you're not buying a new home. And one of those scores can actually drop you out of qualification. Then you get those points back after about 90 to 120 days, okay? But let's come back to inquiries. We talk about hard versus soft. So the biggest thing about inquiries, and I think it's one of the things that's really misunderstood in the mortgage industry and in the lending industry, is how an inquiry impacts your credit score. I'm just curious about what your thoughts are. What have you guys heard? What do you guys think about an inquiry and how they impact your credit score?
Oh, I hear it. Doing leasing, I hear it. I got turned down on 2 houses and they keep pulling my credit score and making my score go down.
Mm-hmm. So they can make your score go down?
That's what but they say, I'm like, is it that quick though? Like, if I go show this house, they get turned down, so they've had their credit run, and now they go over and they have their credit run again because they're applying for another house, and they get turned down again, and now we go to the next one, and it's only been like 3 weeks or 2 weeks.
Technically, it should be a 30-day buffer window.
So then people are blowing smoke. Their score
Yeah,
was
it's
already
45 on
This 45.
mortgages.
The
Well,
CFPBs.
But the window is different than the buffer. Okay, we'll talk about the window here. There's a shopping window. We'll talk about the shopping window, but there's an actual buffer as far as when an inquiry happens and when it actually should impact your credit score according to FICO, and that's 30 days.
Okay, because they sit there and say that it was like, oh, within the last 2 weeks it's gone down because I got turned down on a house.
Yeah. Technically, according to FICO's website, my FICO, it should be a 30 days. So there might be other things going on, and that's a lot of times what we find out is there's other things. There's other things going on that are impacting their credit windows.
Is that when you're shopping the loans?
Shopping loans.
Yeah.
Okay, multiple polls. How many people think that shopping windows exist and that they're there and that they work?
I think they're there.
I know it drops them a little bit.
Mm-hmm. So on average, an inquiry is about 3 to 5 points. 3 to 5 points. The story I always tell to kind of illustrate this is I had a loan officer come to me and say, Chris, can you tell me why my client's score dropped 35 points? All my client did, and he showed me the 2 credit reports, all my client did was went and bought one. So I took a look at it, and there were 14 new inquiries on there from when he bought the car. Okay. Now, technically speaking, in the shopping window world, there's 3 industries. Okay, those have shopping windows. Financial loans do not. That covers like credit cards, any kind of financial bank. So what happened was when he went and applied for this car, they did what's called shotgunning. They shotgun the information out there, or blast and cast, whatever you want to call it. Send the information out to a bunch of lenders and see which one's going to come back with the best deal. For him, it was Ally Financial. Now, of those 14, 4 of them showed up as auto. The other 10 showed up as financial. Okay, so because the other 10 showed up as financial, basically they weren't coded, ended up hurting him. So essentially, he had 11 inquiries against them, and it's about 3 to 5 on average. So he was a little over 3 points per inquiry, which is about the average. So that makes sense. So that's why his scores dropped. Now, I don't have a full, total understanding is that it kind of takes place in another part that's far away from the bank, how that information gets coded and sent. I'm sure it has something to do with the credit reporting company, why it is. I just know that it can be correct. The mortgage industry is not as big a problem. So typically speaking, if you have 8% of the time, so you usually don't have that problem. But there are times where even having a mortgage credit pull could end up showing up as a financial pull or just blank. List the type on there, and I do see that a lot where sometimes it's blank, not fitting into that shopping window. So really getting people to understand, like, yes, there is a shopping window, and it can be anywhere between 14 to 45 days, and it's not 14 through 45 days. It's either 14 or 45 days, depending on. But getting people to understand, like, yes, there is a shopping window, but you still need to be careful. Okay? I know you might be rolling the dice a little bit. It's best to try to stick with shop the lender that you want your credit, even if it's it's not about the credit score. Just I know I have some problems, and you know that going in before your credit score is pulled. We have a client that's in our program, and or they're thinking about joining our program. People pull it until somebody tells them yes. That's where the problem comes in. Really, honestly, it's not somebody that has a 7 credit score and they're shopping lenders. So the best thing to do is get your credit in line where it needs to be. Find a lender you want to go to and go to them rather than it's all about the service that they provide, and they'll tell you that. That's really where, sure, you can go to Chase and get a 16th and it takes 4 months to close, but whatever. So it's like things like that. It's like you don't want to. So just understanding that help them understand here with this new credit. I probably beat a dead horse, but I think it's full.
Exactly.
So a soft pull, you're not going to see it on a lender report, but they do not have a negative impact on the score. You have a credit card company, you're going to apply for a rating. Credit card companies that want to give, and then
the other thing I just realized we didn't mention about inquiries actually posted as a new trade line. Now, they don't impact your score for that whole 2 years. It's really for the first year, wanes until you get to, at the completion of that first year, and then the score impact is gone. Although they are still listed on the report that we pull, shows us 2 years of inquiry. We mentioned earlier that the ideal picture for that if you have 2 installment loans like a car loan, like we said, to maximize, right? 30% of your score, how are you chicken in the egg? How is that going to happen, right? So a very good way to do that is by getting a secured credit card, okay? Versus an unsecured credit card that you actually qualify, right? And they hold to pay the bill every month, and it reports onto your credit report and affects your score just like an unsecured card will. We recommend open or no score and still qualify. You just have to have a source of income. It's very reasonable. It's $35. And their interest rate card, it's not bad. You probably have some unsecured cards with higher rates pretty quickly too.
I think it's the only secured card company I've found that does not pull credit. There was another one, Primer, but now they do pull credit.
Yeah.
So leave green dot. So it is good. So maybe they came out with a secured card product. That's awesome. Good to know.
Yeah, that's good to know. Mom's advice or whatever, and just got funded, and she's made her first credit card payment. She was so proud of herself. But it definitely is a good way to start building credit. There are other minimum credit score. So Open Sky might be step 1, And those other secured cards might be the next step after that. But once the card is used and you kind of get some of those points back from opening new credit and see the benefit to the score, and then you'll be able to qualify. Those are different types of installment loans, can really have the potential to, if they're managed well, installment loan, that's a really good opportunity to benefit the credit score.
Suggest if you're going to go buy your child a car for graduating from college to go put them on a loan too? For the car loan, if you're getting one?
They would have to qualify
Yeah, but-
for that. But it could potentially get like a store.
I know, like when I was young, back in the 60s, my dad says, I'm going to get you a couple credit cards, got me Shell and Chevron or whatever, and boom, it gave me a credit score, things like that.
Yeah. But there are minimum credit score requirements, so it just, it kind of depends on how that works. Self-reporting report rental housing payments to, like I said, self-reporting to your credit report, and it will show up as an account. Okay.
We have them send a paper as the property manager.
Yeah.
We get for only a few, but they send us a thing every month, and you write down if they pay their rent.
Right, yeah. Okay, so that's how it works. So we, and you've got the link there in your packet too, we use a company called Rock the Score, and it will report that to Equifax and TransUnion. And it will be your ongoing rental payments will show up as an account on your credit reports. So for someone with a thin file, that could help to build.
I did a lot of research on rental reporting companies. Like I think I probably talked to like 5 or 6 different ones. Most of them only report to TransUnion. This is the only one that I found that reports to 2, TransUnion, Equifax. Now TransUnion will almost take will take almost anything. Like literally, if you're renting a room at mom's house, they will report that through the reporting company. So if you sign up with that company, they'll report it to TransUnion. Equifax is a little bit trickier. It needs and requires a management company or like an apartment complex or something like that that they will report and see that as So this is why we recommend this company, and I worked a deal with them. So if you go to that link there, that it will the clients will get a little bit of a discount going to that link there.
Yeah.
So the reporting, and again, because we're property managers, it's interesting. So when we pull credit reports on people trying to make a decision, some of them do show a rental history on the credit report. Does that mean that person is doing something like this, or is that management company automatically doing it?
It could be, depending on how you're pulling it. It could be, if it's like a mortgage credit pull, but there might be some other kind of rental reporting thing system that they have that's showing something different in there, that's showing both the credit score. And I don't know enough, I'll be honest, I don't know enough about how, but I've talked to an entity that might pull from that's showing that's not necessarily, I could look at the credit report and tell you almost automatically if it is rental reporting. One of the best ways to kind of note is if they do have like a Credit Karma account or something like that where they can look at it, and if it's a third-party credit monitoring company, then it's probably just some kind of other rental reporting information that they're pulling from another rental database.
I know on there that you can report to the credit agencies.
Really? So why do we not do that?
Because a lot of that stuff on our thing, which is veering off, is
Yeah, so, and that's where Rock the Score for like an $8 fee or something monthly fee for the client will do the legwork. They'll do the legwork of actually contacting the management company, getting the information, and then reporting
we
it.
get those faxes a lot of times.
Yeah. And the other thing too is with like a $99 startup fee with it, years of rental history and report that. So sometimes that can be a big instant boost, and we've seen some clients get. I actually just looked at her credit report recently where the client got at least a 40-point boost from doing that. Oh yeah, if you've got to go, you want to go ahead and pass that around, and I'll continue late. But if you guys got something else to do, I understand. So identity theft and identity errors. They did a study. They found that 7 out of 10 credit identity related or error related. We're going to go on, and we kind of were talking about this at the beginning of the class a little bit. But one thing, Susan and I actually both got a phishing email yesterday for, like click here to see your closing docs. And I was just curious. I started called the phone numbers that were in the signature line for this mortgage person, went to the website that was on there, and there was all bogus. It was all fake. And you guys probably get some stuff like that, obviously, but it can be a big problem. When you click on those, it gets into your system, but then also sometimes you get phished by having a site that says, oh, click here to log into your Facebook page to do this or do that. Well, then as soon as you log in, now they have access to your Facebook page. So, and that can cause a whole bunch of other problems. But other kinds of identity theft, mail theft, dumpster diving, this is all basically where people are going, just gets, sold out on the dark web.
What's pretexting?
So pretext, it's a great question. That's basically
To gain more retired person, so I'm going to call them and that needs bail money, right? Or I got a call of documents. It's important. So I called and 2012, and I know, right? So, but still, I was very threatened by.
But it was
the
a
fact
bogus
that
debt. It wasn't real.
It was completely. Yeah, I've never had. I mean, absolutely, never had that. That debt, didn't recognize anything, so just be aware. But there are lots of scams like that where they know a little bit and they use that to pry and get more.
Yeah. So, but phishing, we kind of talked about that. You got to be careful of those emails, breaches, ransomware, wire fraud. This one's a big one in the real estate industry is wire fraud, and really understanding that and it happened in the wrong place. It was wired to a bad person rather than.
Well, they were having fraud in the title companies.
Yes.
The last 2-3 years.
And the title company's no longer with us. So.
Yeah.
But there's a big thing. I think it was on.
That was the big issue there.
Yeah. But it was, and I think there's some news stories and stuff that were done here locally on what happened with that. But it's a big deal, and you always got to be careful with wire fraud. But it's all kind of in the identity theft. Now, a lot of the stuff that we described there does not a lot of times rise to the level of actually showing up and impacting your credit score. Identity errors a lot of times will impact your credit score more than identity theft. So same last name, same zip code. So if your name is Johnson, Smith, Jones, Gonzalez, Lopez, a lot of times you're going to have things end up on your credit report that don't otherwise belong to you. Juniors and seniors, we see that a lot, where a lot of times, John Hickens Smythe Jr. has stuff on his credit report from his dad who's not a very good person, or vice versa, whatever.
Yes, I've seen that.
Yeah. And then this one is kind of the crazier one, which is 4 letters out of a name, matched with 7 out of the 9 social security numbers.
I had that happen to me too.
You did?
Really?
Yeah,
Wow.
I was working with a bank for 10 years, 12 years, and all of a sudden they said that you owe some money because the last 4 digits equal something that happened in Tennessee. And I said, I never worked in Tennessee.
Yeah. So, but there was a client that I had. His first name was Roberto, and his credit got mixed up with somebody by the name of Robert, and there was only 1 digit difference in their social security number.
Well, I have a common last name of Brown, unfortunately.
Brown,
I
yeah.
had trouble with my credit several times. Back when I moved here in 91, somebody threw a judgment on me against in Orange County, California, and I never was.
Yeah.
I lived there, but I never did anything.
Yeah.
To a particular company, I had to get an attorney to get it off because of, again, the last 4 digits of social security number.
Yeah, no, I had a client. His name was Joe Jones, and lived in East Texas. And there's a few Joe Jones in East Texas, and he had like 7 judgments on his credit report that weren't his. So
I'm
all
sorry,
because of
I
that.
don't
No,
know.
I totally understand. But yeah, we're going to go through this here. Negative items I can report on the credit report: collections, bankruptcies, inquiries, tax liens, repos. These are all the types of negative items that can show up on their credit report and obviously have an impact on the credit score. So now we're going to talk about collections. And this will be the last thing that we talk about, right? Because we already covered the last part of it. Yeah. So collection type. So a lot of you guys had questions about medical collections, but there's different types of collection types. There's charge-offs, there's profit and loss, and then there's collections. And within the collection types, you can have utilities, student loans that are in collections, medical collections, The most common collection that's on the credit report is a medical collection. But there are certain collections that mortgage companies aren't going to care about, banks aren't going to care about, and there are certain ones they will. Student loans that are in collections are ones that they will definitely care about.
Those are very important.
Those are very important. Now, if you're going to get a government-backed loan and you already have a government-backed loan that's in collections, like a student loan, you cannot get another government-backed loan. So you're going to end up on what's called a Cavers report. So whenever a lender is doing an FHA loan or a government-backed loan, they have to pull Cavers and they have to clear Cavers. If you ever hear that term, oh, the client needs to clear Cavers, that's what they're talking about. So that's why if a client comes to us and says, well, can you just get that student loan removed from the credit report? I'm like, sure, technically by law, per the Fair Credit Reporting Act, we can, but that still does not clear it from Cavers, and you're still not going to get an FHA loan. Now, I've actually had some clients that have been through the process and they had like massive collections they were never going to pay off, and they were trying to go conventional to get around that whole Cavers thing. So, that is something that we definitely look at, and that can definitely keep someone from getting a loan if it's there. And student loans, as we all know, can't include it in bankruptcy. It's there for life, so you got to pay it, right? But other kind of collections that really hurt you is medical collections. A lot of people have said, well, I heard that medical collections aren't going to impact the credit score anymore. I hear it all the time. Like, oh, I read this article that medical collections aren't going to impact the credit score, or they're going to drop off, or they're not going to report anymore. I'm like, they've been talking about that since I got in the industry, almost 12 years ago. So, but I've still never seen it. And right now, as of today, medical collection hits the credit report, it's going to impact your credit score pretty much like any other type of collection. The story I told earlier of the zero balance collection still hurt the credit score. But that leads to this part right here, which is new versus old collections. How many people think that if you pay a collection that it removes it from the credit report? Yeah. How many people think that if you pay a collection that it helps your credit score?
I think so.
You think so? No. So renews the date of last activity, and that was the last question I had. I think you've seen people's scores dropped up to 90 points.
Is there like a time limit on it? And I've had, just reported 2 or 3 months ago. If they pay it right away.
Typically, yeah.
Is it just the ones that?
Yeah, if you see it hit
right away,
and then you pay it like that, then it's not going to have an impact. It's those old ones. Like the story I always tell is a client, she called me up in tears. She had the home picked out of her dreams. She was a single mom, 3 girls, trying to get her life back together. And she got a call about a medical collection. They said, oh, if you can't close on a mortgage with a medical collection, so you need to pay me. By the way, I'm going to give you a deal. I'll only charge you half of what you owe. Okay, great. I'll pay it. I can get this home. It was a debt. It was definitely a legitimate medical collection, but the collection agency used scam tactics, because it's not the truth. You can definitely close on a mortgage loan with a medical collection, any of that. But she didn't know that. She paid the collection. Her scores dropped 50 points. She lost the home, lost her, earnest money, whatever, and so it was a bad thing all around for her. And that's why she called me up in tears. And I was able to go in and quickly get the collection removed and get it back up. She found another home. Happy story at the end. But she's not saying don't pay your collections. That's not it at all. It's got to be strategic, though. We got to have a plan in place because a lot of times what we're doing for clients is we're using laws to actually go after and challenge the negative items on their credit report and force the creditor, who the onus is on them, to prove the client 700 items across 17 different categories. By law, they're supposed to keep on file for 7 years to show the accuracy and validity. And if they don't have that information on file, and they can't show that within a 30 to 45 day time frame back to the credit bureaus, by law, the credit bureaus must deem the item as erroneous and thus remove it from the credit report. So a lot of times that's what we're doing. That's the credit repair side of what we're doing here. Decide in some cases, well, which collections would you pay that might actually make sense to pay? And there are some collections that if you pay, your scores do go up. I know, like, didn't you just tell me that's not true? But there are. And the ones that matter are if you have a credit card that's in collections. Let's just take First Premier as an example. If you have a First Premier credit card, a lot of times they will hold on to that because they have their own internal collection agency. They do not sell it off to a third party. So a lot of times you might see a First Premier credit card. It's got a $300 credit limit and a $450 balance on there. So we talked about the utilization before. Well, what's 450 and a balance and a $300 limit. What's that utilization? You're like 150%. Yeah, he's like, most people are like, I was told there was not going to be any math in this class, but so yeah, you're right. 150% utilization is exactly it. So, but if you go over that 100%, you actually get hit negatively in that 30% section that we talked about. So in that case, if you take $100 and they show it and post it as a zero balance, your scores in that case you go up.
So you also have to specify the language that we're settling this to.
Correct.
Paid in full or a
And we help our
balance.
clients through all that. We help our clients, we walk them through, here's 100% of what you say, here's what you need to get, here's what you need to get in writing, here's all these things that you need to get. And clients come to us with things you need to go through to pay it. So paying collections can be helpful to the process, but you really need an expert to kind of look at it and see which ones to pay and which ones not to pay. Because which are the ones that the clients will pay the first? It's that that credit card that was charged off 5 months ago. But maybe that's the one you should pay. I think that's it. Did you guys learn anything?
Yeah.
Helpful. Hopefully.
Right.
Well, yeah.
A lot of it.
Some of it was,
information.
but it
Right.
was like helpful.
Well, I just wanted to remind you that we're here to be a resource to you. You may just come up with a question, even if you're not calling to help us work with a client or whatever. And if you just want to know, like, hey, I don't understand why the credit score went down like this. Can you take a look at this credit report? Absolutely. Like, let us sit down and take a look at it. If I can't figure it out, I'll call Chris. We'll put our heads together and do like a little home buyers seminar or a meet and greet with home buyers. I'm available to come and just talk a little bit about credit and be there to help us as your partner. That's what obviously what we're trying to start here are relationships that will benefit both of us long term. So if you like the class, our Facebook page and give a review or a Google review at elevatemyscores.com/Google. But all of those would definitely help us and help others to know that this is really great information. So.
Yeah, I mean, it's not necessarily about us as a company, but just about the class. And then lets other realtors know out there that, hey, this is, a good class and something that I should definitely attend in the future. And if you're, if your brokerage where you're at, if you feel like something that, this would benefit the brokerage, we can also come in there and do a class, there as well. So, but thanks for coming. Did everybody get a chance to sign the sign-out sheet?
Yep, here, draw for
So I have a quick question on the K reports. How long does it take to correct those once the people start paying on their student debts again?
Usually about 4 months. I think they need 4 months of showing payments before they can get out of what I call student loan jail.
It's 3 months of payment.
3 months?
And then if it's on paper, you can reach out to paper and get it.
Yeah. The loan officer is usually the better one to answer that, but I just go off of what I hear from them.
She is a loan officer.
Oh, you are? Oh, okay. Sorry. I thought you were a realtor.
That's not in.
Okay. Sorry. All right. So I drew the name Dustin.
Thank you.
Thank you so much. Thank you everyone for coming.
Thank you.
There you go. Hey, thank you. Thanks. Hey, do you mind getting a picture? Absolutely. For our Facebook page showing that? All right, there you go.
You want to go to the bathroom before we go?
Yeah, I gotta do that.
Other side, I'm going to hold this like this.
All right.
Yeah.
I got your logo in
That's
there.